January 29, 2026. While you were scrolling TikTok and pretending to work from home, something absolutely insane happened in the financial markets. Something that has only occurred to WICE before in recorded history. Silver. Yes, boring old silver. The metal your grandmother's silverware is made from hit dollar, 121.67 per ounce. So what you're thinking? Numbers go up, numbers go down. What's for lunch? Here, guess what? In the entire history of silver trading, re-talking thousands of years of human civilizations, silver has only gone completely parabolic 3 times. And now, 2025 to 2026. That's it, 3 times, in 45 years, and the last 2 they didn't. End well for people who ignored the warning signs. But here's where this gets deliciously terrifying. This 3rd time, it's not like the other 2 at all, because this time, it's not speculation driving the price, it's not greed, it's not market manipulation. This time, the world is literally running out of silver. Let me paint you a picture of what going parabolic actually means. Because the mainstream financial media loves to bury these stories behind boring headlines like, "Precious metals, see volatility." In 1979, silver was trading at $6.08 per ounce. Normal, boring, the kind of price that makes accountants nod off during presentations. Then something happened. By January 18, 1980, silver hit $49.45 per ounce. That's an increase of 713% in 1 year. In 2011, it happened again. Silver climbed from about $12 in late 2008 to $48.70 in April 2011. Not quite as dramatic, but still an increase of over 300%. And now, silver gained 144% in 2025 alone, finishing the year above $70 per ounce before exploding to $121.67 in January 2026. But here's what the financial press won't tell you, what they desperately hoping you won't figure out. These aren't random events. They're symptoms, warning signs that something is fundamentally broken in the global financial system. Let me show you what I mean. The story you've been told about 1980 is a lie. Well, not a complete lie, more like a very convenient oversimplification designed to make you miss the real story. The official narrative goes like this. 3 rich brothers from Texas Nelson Bunker Hunt, William Herbert Hunt and Lamar Hunt, tried to corner the silver market. They bought up massive amounts of silver, drove the price to $50, and then crashed the market when regulators changed the rules. The end. Cute story. Simple, easy to understand, and mostly wrong. Here's what they don't tell you. In 1979, the U.S. was experiencing some of the worst inflation in its history. The dollar was collapsing. Confidence in the government was at an all-time low. Gold, platinum, palladium, oil, literally, every commodity was going parabolic. The Hunt brothers bought 250 million ounces of silver at their peak. According to the 2018 Silver Yearbook from CPM Group, there was roughly 2.8 billion ounces of above-ground investable silver in 1980. So the Hunts controlled about 8.9% of investable silver. Not 1/3, not half. 8.9%. Jeffrey Christian, one of the most respected experts in precious metals, estimates the Hunt brothers might have contributed 50 to 75 cents to the silver price, not $1.50. So, what really drove silver to $50? Rampant inflation, a collapsing dollar, wars, oil embargoes, political instability. People worldwide were fleeing paper currency and flooding into hard assets. Any hard assets. On January 21, 1980, both gold and silver peaked on the exact same day. Gold hit $850 per ounce. Silver hit $50. Platinum, palladium, oil, everything spiked together. But blaming 3 Texas billionaires for a global monetary crisis, much easier than admitting the U.S. came dangerously close to losing control of the dollar. The Hunt brothers were the scapegoat, the distraction, the story that lets everyone pretend it was manipulation, not monetary madness. But the madness was real, and it came back. Fast forward to 2011. The Hunt brothers are dead, so silver should be safe from manipulation, right? Wrong. Silver spiked again, from about $12 in 2008 to $48.70 in April 2011, a 390% increase in less than 3 years. And you know what the excuse was this time? There wasn't one, because there was no one to blame. Instead, silver did what it always does when people lose faith in the financial system. It became a safe haven. In 2008, the global financial system nearly collapsed. Lehman Brothers failed. AIG got bailed out. The Federal Reserve and other central banks launched their quantitative easing programs, which is fancy talk for printing trillions of dollars out of thin air. Investors panicked, not about manipulation, about inflation, about currency debasement, about whether the entire Western financial system was about to implode. So they bought silver and gold. Physical metal, things that couldn't be printed, things that couldn't be bailed out, things that had been money for 5,000 years while governments and currencies came and went. The silver price surge of 2011 was driven by ordinary investors changing their preference from paper to metal. Investment demand for silver surged to record highs. No Hunt brothers needed. Just fear. Just rational people looking at quantitative easing and massive government deficits and thinking, you know what, maybe I should own something real. And then what happened? Silver crashed. From $48 in 2011 to below $14 by 2015, a 70% decline. Except, here's the thing. The reasons people bought silver in 2011 never went away. The debt didn't disappear. The money printing continued. The fundamental problems just got bigger. Which brings us to now. To the third time, to the one that's different, because this time it's not just fear driving the price. This time there's a physical shortage. And shortages, they don't care about regulations or scapegoats or central bank policies. When the metal runs out, it runs out. Let us talk about something the silver bulls do want you to worry about, and the silver bears pretend doesn't exist: the actual physical supply of silver on planet Earth. In 2025, global silver demand reached an estimated 1.24 billion ounces. That's a big number, lots of zeros. But here's the number that should make you nervous. Total supply, including mine production and recycling only, amounted to about 1.01 billion ounces. Let me do the math for you. Since apparently Wall Street analysts are allergic to calculators, 1.24 billion to 1.01 billion equals 230 million ounce deficit. That's not a surplus. That's not balanced. That's a deficit equivalent to the entire annual output of Mexico, the world's largest silver producer. Just gone, vanished, consumed, and not replaced. But surely this is new, you're thinking. A one-year blip. Nothing to worry about. Oh honey, sweet summer child, sit down. The silver market has been in a deficit for 5 consecutive years. 2021, 2022, 2023, 2024, 2025. 5 years in a row where we consumed more silver than we produced. The cumulative deficit from 2021 to 2025. Almost 820 million ounces. That's not a rounding error. That's not market fluctuation. That's nearly 1 billion ounces of silver that used to exist above ground and now doesn't. Where did it go? Let me show you. Here's what makes silver different from every other precious metal land. What makes this situation absolutely unprecedented. Silver isn't just money. It's not just an investment. It's an industrial commodity, the most conductive metal on Earth, irreplaceable in thousands of applications. And the world's appetite for silver is growing faster than anyone predicted. Solar panels. In 2015, solar installations used 60 million ounces of silver. Not bad, manageable. In 2024, 232 million ounces, nearly 4 times as much. Global solar installations reached around 655 gigawatts in 2025, growing about 10% year over year. Every single panel needs silver, the most conductive, most reflective material we've got. Sure, manufacturers are trying to reduce the silver content per panel, but the sheer scale of solar deployment keeps baseline demand structurally high. Electric vehicles, a traditional car uses about half an ounce of silver. An electric vehicle between 2 to 3 times that amount. Every sensor, every circuit board, every power management system all needs silver. China sold 11 million EVs in 2024 alone, and that's just one country. The projected additional silver demand from EVs by 2030, 100 million ounces. But wait, there's more. Because apparently, the universe has a twisted sense of humor. AI, artificial intelligence, the thing everyone's obsessed with. The technology that's supposedly going to replace half of all jobs and make us all obsolete. Guess what AI data centers run on? You guessed it, silver. Every advanced chip, every high-performance server, every semiconductor that makes ChatGPT work requires silver's unmatched electrical conductivity. Industrial demand hit a record high in 2025, projected to surpass 700 million ounces for the first time in history. Nearly 60% of all silver demand now comes from industrial uses. Let that sink in. Silver used to be primarily an investment metal, a monetary metal. Now it's being consumed, literally destroyed in industrial applications at a rate that mining can't match. You can't recycle silver from a solar panel that's been installed on a roof. You can't get it back from an EV circuit board that's driving down the highway. You can't unuse it. It's gone. Okay, you're saying, but can't miners just mine more? Oh, if only economics were that simple. Let me explain why that's adorably naive. In 2025, global mined silver supply remained flat year over year at 813 million ounces. The same, no growth, zero. But prices are skyrocketing, you protest. Surely miners are incentivized to produce more. Here, as the dirty secret about silver mining that the industry doesn't advertise. About 70% of silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. Think about what that means. When you're mining copper, you get some silver along the way, but you're not mining for silver, you're mining for copper. So even if silver prices double, you're not going to increase silver production unless copper economics also makes sense. It's like asking a chicken farmer to produce more eggs when you're only paying more for chicken meat. The farmer isn't raising chickens for eggs. Eggs are just a bonus. Higher egg prices alone won't make them raise more chickens. And primary silver production mines that actually focus on silver. They face a nightmare of challenges, permitting delays. Getting approval for a new mine takes 8 to 12 years in most countries. That's not a typo, 8 to 12 years. By the time you get permitted, market conditions have changed 3 times. Capital intensity, building a modern silver mine, costs hundreds of millions of dollars. And investors, they're skeptical. Silver crashed 70% after 2011. Remember, try convincing someone to invest $500 million in a mine for a metal that might crash again. Declining ore grades, the easy-to-access, high-grade silver deposits, we mined those decades ago. Now we're digging deeper, processing more rock for less silver. It's the law of diminishing returns playing out in real time. The result? In 2025, mined silver supply is expected to remain flat, not growing, while demand continues to surge at current consumption rates and production levels. Supply-demand analysts project deficits exceeding 200 million ounces annually for the foreseeable future. That's not a correction coming. That's a structural imbalance that can't be fixed with more money or better technology. It's geology, it's physics, it's reality. But surely things can't get worse, right? Surely there's some relief valve, some mechanism that prevents a full-blown crisis. Well, about that, on January 1st, 2026, China, the country that produces and exports more silver than almost anyone, implemented new export restrictions on refined silver that are already sending shockwaves through global markets. Under the new policy, only large state-approved companies are allowed to export silver, and only after obtaining special government licenses. To qualify, firms must meet to stringent conditions, an annual production capacity of at least 80 tons of silver. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. Translation: China just turned silver into a strategic resource, like rare earths, like lithium, like all the other critical materials that China controls, and the West suddenly realized they desperately need. Why did China do this? Let me count the reasons. 1. Geopolitical leverage. If you need silver for your solar panels, EVs, and AI infrastructure, and China controls access to silver, congratulations, you're now dependent on China for your entire green energy transition. 2. Domestic industrial demand. China itself is the world's largest manufacturer of solar panels and EVs. Why export silver when you need it for your own industrial base? 3. The same reason they're hoarding gold. They're preparing for a post-dollar world. Silver, like gold, can't be printed, can't be sanctioned, can't disappear with the stroke of a pen. The immediate effect of China's export restrictions: chaos. Physical silver in Shanghai started trading above $80 per ounce in late 2025, while COMEX futures remained much lower, around $30 to $35 per ounce. Read that again. The same metal, trading at wildly different prices depending on whether you want paper contracts or actual physical silver. That's not market efficiency. That's a market screaming that something is fundamentally broken. It's the canary in the coal mine dying, and everyone's standing around arguing about whether canaries are even real. Analysts projected a 2025 deficit of approximately 230 million ounces, driven by soaring industrial needs. With China's export restrictions in place, some industrial regions now have barely 30 to 45 days of accessible silver reserves. 30 to 45 days. That's not a strategic reserve. That's a just-in-time inventory system, one hiccup away from complete shutdown. And speaking of shutdowns, let S talk about what's happening to the physical silver that's supposed to be backing all those ETFs and futures. Contracts you've been trading. Pop quiz. If you own silver through an ETF or a futures contract, do you actually own silver? The answer is maybe, kinda, sorta. It depends on whether the vaults actually have the metal they say they have, and whether you can actually get it delivered, and whether the counterparty doesn't default, and about 17 other variables that should terrify you. Let me show you what's happening to the physical silver markets right now. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association, LBMA vaults, have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. In early 2025, significant amounts of silver flowed into the U.S. as bullion banks and other market players built a stockpile to avoid potential tariffs. The metal got trapped in New York. Despite the U.S. government saying precious metals are exempt from tariffs, the silver stayed put because of concerns it could still face import taxes. So you have silver in the wrong location, in the wrong form, unable to move to where it's actually needed. Meanwhile, London, the global benchmark for physical silvers, running dangerously low. In October 2025, London's liquidity squeeze was so severe that lease rates jumped temporarily to over 30%. 30%. For context, normal silver lease rates are around 1%, maybe 2% if things are tight. 30% means someone is desperate for physical metal and willing to pay extortionate rates to get it. Silver spots in London traded far above futures prices, a condition called backwardation. In a normal market, futures trade at a premium to spot because of storage and carrying costs. Backwardation means people value physical metal now more than promises of metal later. That's the market screaming, we don't trust paper contracts anymore. Show us the metal. Here's where this gets interesting, and by interesting, I mean potentially catastrophic for anyone holding paper silver for decades. Silver has traded in two parallel markets. The paper market, COMEX futures, ETFs, bank certificates, easy to trade, high liquidity. You can buy and sell millions of dollars worth with a few clicks, convenient, modern. The way God and Goldman Sachs intended, the physical market, actual bars and coins sitting in vaults or in your sweaty hands. Clunky, expensive to store, hard to transport, inconvenient, old school. For most of history, these two markets traded at roughly the same price because they represented the same underlying asset. If paper got too expensive, you'd buy physical and sell paper. If physical got too expensive, you'd do the reverse. Arbitrage kept prices aligned. But in 2025, something broke. In Shanghai, physical silver traded above $80 per ounce. In New York, COMEX futures were in the $30 to $35 range. That's not a small difference. That's not temporary dislocation. That's a 130% premium for actual metal over paper promises. Let me put this in terms even your crypto bro neighbor can understand. Imagine Bitcoin trading at $100,000 on Coinbase, but only $43,000 on Binance. For the same Bitcoin, that wouldn't last 5 minutes before arbitrage traders evened it out, right? But with silver, this divergence persisted for months, because moving physical silver across borders, especially with China's export restrictions, is unlike clicking transfer on a crypto exchange. The silver market is now experiencing what every commodity market eventually experiences. When supply gets tight, the paper market and the physical market decouple. Paper trades based on speculation and leverage. Physical trades based on actual supply and demand. And when they decouple, the paper price becomes increasingly meaningless. It's like trading IOUs for prime rib while the restaurant runs out of beef. Sure, your IOU says you own a stake, but good luck actually eating it. This shift represents more than a temporary ralliet, as the early stage of a structural repricing of silver as both an industrial and monetary asset. Once physical delivery becomes the benchmark for price discovery, the traditional futures exchanges like COMEX may lose control of global pricing altogether. Sound familiar? It should. It's exactly what happened to lithium and rare earth markets when physical shortages emerged. Paper prices became divorced from reality, and the physical market took over as the true price discovery mechanism. Want to know how insane this silver situation has become? Let me tell you about Costco. Yes, Costco, the place where you go to buy 48 rolls of toilet paper and a hot dog for $1.50. They started selling silver bars in 2024, and in 2025, they had to implement purchase limits. 1 silver bar per customer. Think about that. Costco, the retailer famous for selling everything in bulk, where the business model is literally buy more, save more, is rationing silver bars. 1 per customer, like it's toilet paper during the pandemic. When Costco starts rationing precious metals, that's not a market, that's a frenzy. But it's not just retail investors going crazy. ETF inflows have increased by 187 million ounces so far through 2025, according to the Silver Institute. That's institutional money. Pension funds, hedge funds, the smart money that's supposedly too sophisticated to panic. They're panic buying because they've run the numbers. They've seen the deficits. They've looked at China's export restrictions and industrial demand growth and mining production, that's going nowhere. And they've reached the same conclusion. There isn't enough silver. Period. End of story. Okay, you're saying, but silver spiked in 1980 and crashed, spiked in 2011 and crashed. Why won't it crash again? Great question. Let me show you why this time is fundamentally different. 1980. Cause: inflation crisis plus Hunt Brothers accumulation driver. Monetary fear plus speculation. Industrial demand: low, approximately 30% of total demand supply situation, surplus resolution, regulatory intervention. Margin requirements changed. Hunt Brothers forced to sell outcome crashed from $50 to $10 in months. 2011, cause financial crisis aftermath plus QE fears driver. Investment demand plus inflation hedging. Industrial demand: moderate, approximately 50% of total demand supply situation. Roughly balanced resolution, Fed taper talk. Economic recovery hopes, profit-taking outcome, crashed from $48 to $14 over 4 years, 2025 to 2026, caused structural supply deficit plus China export restrictions plus industrial demand explosion driver, physical shortage plus green energy transition plus AI infrastructure. Industrial demand: dominant, approximately 60% of total demand and growing. Supply situation: 5-year consecutive deficit totaling 820 million ounces resolution. Outcome: do you see the difference? In 1980 and 2011, silver spiked because of investor sentiment, fear, speculation, things that can change overnight. In 2025 to 2026, silver is spiking because the world is using more silver than it's producing. That's not sentiment, that's physics, that's reality. You can't regulate away a physical shortage. You can't change margin requirements and make solar panels need less silver. You can't taper QE and suddenly make more silver appear in the ground. The first 2 times were psychological. This time is geological. The first 2 times were speculative bubbles. This time is a supply crisis. The first 2 times could be fixed by changing rules or shifting sentiment. This time, the only fix is to either drastically reduce consumption, good luck telling China to stop making EVs, or massively increase production, which takes 8 to 12 years minimum. Neither of those solutions is happening fast enough to prevent what comes next. So where does this end? Let me give you the 3 most likely scenarios, ranked from uncomfortable to apocalyptic. Scenario 1, the managed slowdown governments coordinate. Industrial users stockpile. Substitution accelerates. Solar panel manufacturers figure out how to use less silver per panel. EV makers find alternatives. The deficit narrows gradually over 3 to 5 years. Prices stay elevated, $60 to $80 range, but don't explode further. Probability, 30%. Why it might happen: technological innovation, government intervention, coordinated action. Why it might not: technology doesn't advance fast enough. Industrial demand keeps growing. China doesn't cooperate. Scenario 2. The price shock. The deficit persists. Inventories continue depleting. More industries start facing supply issues. Prices spike to $150 to $200 per ounce over the next 12 to 24 months. As physical shortage becomes undeniable, paper markets lose credibility. COMEX faces delivery failures. Chaos in commodity markets. Eventually, high prices destroy demand and encourage new production, but not before significant economic disruption. Probability 50%. Why it might happen? Current trends continue. No major policy changes. Physical shortage worsens before it improves. Why it might not? Demand destruction happens faster than expected. Recession kills industrial demand. New supply comes online sooner than predicted. Scenario 3. The system break. The paper market completely decouples from physical COMEX, and other exchanges faced force majeure events' inability to deliver against contracts. ETFs can't source physical metal. Industrial supply chains seize up. Solar installations halt. EV production slows. Electronics manufacturing faces shortages. Governments declare silver a strategic resource and implement export bans. Black markets emerge. Prices become meaningless as physical metal simply isn't available at any price in normal channels. Probability 20% why it might happen. China's export restrictions tighten further. Other producing nations follow suit. Deficits worsen faster than expected. Cascading supply chain failures. Why it might not, too extreme. Governments intervene before it gets that bad. Demand destruction prevents worst-case scenario. The smart money is betting on something between scenarios 2 and 3, not quite apocalyptic, but definitely worse than managed slowdown. Major banks are raising their price targets. Bank of America, $65 per ounce. BNP Paribas, $100 per ounce by end of 2026. And remember, these are conservative institutions that hate making bold predictions. When banks start talking about $100 silver, it's because they've seen something in the supply-demand data that scared them. And you know what? They should be scared, because we've never been here before. Silver has only gone parabolic twice in modern history. Both times ended in spectacular crashes. But both times, the underlying fundamentals could be fixed by changing sentiment or regulations. This time the math doesn't work. The geology doesn't work. The timelines don't work. This time, we're watching a slow-motion train wreck where everyone can see the crash coming. But no one can stop it because the brakes don't exist. Let me be crystal clear about something. I am not giving you financial advice. I'm a YouTube documentarian, not your financial advisor. If you make investment decisions based on a documentary, you have bigger problems than silver prices. But I will tell you what the data says, what history says, what basic supply and demand principles say. And the data says we're in unprecedented territory. Silver is now over 100% above its 200-day moving average. In 2011, it topped when it was approximately 84% above. So, by traditional technical indicators, silver is overbought, stretched, due for a correction. Except, technical analysis assumes markets operate on normal supply-demand dynamics. It assumes that high prices will bring out more supply. It assumes that demand is elastic. None of those assumptions hold true when you have a 5-year structural deficit, China weaponizing exports, industrial demand that's growing, not shrinking mining production that can't increase fast enough, inventory levels that are depleting. Not rebuilding markets can stay irrational longer than you can remain solvent. That old Wall Street saying is true. But this isn't irrational. This is a fundamental shortage playing out exactly how shortages always play out, with prices going up until something breaks. Let me leave you with 3 lessons from silver's history. 3 truths that held in 1980, held in 2011, and will hold in 2026. Lesson 1. Silver is volatile, brutally so. It has routinely plunged 70 to 90% after experiencing powerful rallies. Anyone buying silver needs to understand they're strapping into a roller coaster, not a gentle escalator ride. If you can't handle watching your investment drop 50% and still hold on, silver is not for you. Lesson 2. Physical beats paper when things get weird in 1980. Paper contracts were worth nothing when delivery failed. In 2025 to 2026, we're watching the same thing play out as physical premiums explode while futures lag. If you own silver, own physical, or own something with allocated storage, where you know exactly which bars are yours. Paper promises have a nasty habit of disappearing when you need them most. Lesson 3. The trade ends when no one expects it. Both 1980 and 2011 peaked when bulls were most confident, when everyone knew silver was going higher. When $100 or $200 predictions were common, maximum bullishness equals maximum danger. So, if you're in this trade, have an exit strategy. Have a price target. Have a plan for when the music stops. Because it always stops. The only question is when. Here's the calculation you need to make. On one side, the possibility that this time isn't different, that silver will crash like it did in 1980 and 2011, that somehow supply will magically appear or demand will evaporate, that all the smart money is wrong and the deficits will resolve themselves. On the other side, the possibility that this time is different, that a 5-year structural deficit, combined with export restrictions and exploding industrial demand, is creating a genuine supply crisis, that we're rewatching the early stages of a repricing that makes $121 per ounce look cheap in hindsight. Only you can decide which side weighs heavier in your calculation, but make the decision with your eyes open, with the full picture, with an understanding of what's really happening beneath the headlines. Because silver has only done this twice before in modern history, and both times most people missed it until it was too late either, missing the rise or getting caught in the crash. The third time is happening now, right now. While you're watching this video, the silver market was in a deficit for the 5th consecutive year in 2025, marking an 820 million ounce cumulative shortfall. China implemented strategic export restrictions effective January 1, 2026. Industrial demand hit all-time records. Vault inventories depleted to dangerously low levels. Lease rates exploded to over 30%. The price hit an all-time high of $121.67. These aren't predictions. These are facts, things that have already happened. The question isn't, is silver spiking? It's, do I understand why, and what do I do about it? If this documentary just changed how you see precious metals markets, hit that subscribe button, because the story's not over. Not even close. Stay informed, stay skeptical, and maybe, just maybe, take a second look at that old silverware your grandmother left you. Because in a world running out of silver, even spoons might be worth something.